All right, good morning and welcome to the main management weekly market note for Freaky Friday, March 13th, 2026. There's a lot going on. As usual, I'm Alex Varner, our head of research here alongside
Alex Dippery, research analyst here at Maine.
Let's get into it. As usual, our offerings by WTMAT, SEC, INTL available all over the place wherever you get your single tickers there. On the performance side, of the bottom are the two trailing week data points, and you can see a lot more red than blue. It's kind of energy and utilities were the two sectors that were up. Energy obviously getting bid off of the oil on the Iran conflict, and then commodities on the broad index side of things up 4.4. Again, that's oil's in there. That's a big driver for that performance. Year to date, commodities lead the way up staggering 35%. And then on the sector performance, energy is up head and shoulders above everybody else at 29, followed by utilities at 10 and staples. So clearly a kind of defensive positioning, and that energy is really getting bid, as we mentioned, by oil. Recession dashboard, not a ton has changed during the month. We look at this regularly, but it takes each column has a couple of different items within it. So you need to see kind of an overall shift within the things in a column before we're going to kind of shift that whole column as well. But overall, kind of, blue to green across the board there. So nothing really flashing up kind of warning signs as of yet. On the data front, there was a lot of data last week. We're still working through the government shutdown delays, which is why we got core PCE in the middle of the month. But basically, it was up 0.36% month over month, in line with forecasts. But that's the fastest monthly gain since Feb of 25. On a year-over-year basis, it's now up 3.06%. That's the most since March of 2024. So that's going the opposite way that the Fed wants. Their stated inflation target remains 2%. This is running hotter than CPI and core CPI. And this is the Fed's preferred inflation measure. So I think, the concern here is this thing keeps running. Energy's not going to help this. Core is X energy, X food, but still energy is, something that people feel more acutely when you go to the gas pump. I filled up this morning. It's not gone north by northeast yet, but I think that is shortcoming. On the right, you see the breakdown between goods and services. Goods have been deflationary. That was down 0.42% month over month, while services continue to kind of grind higher, up 0.33. I think services have had something like 11 or 12 straight up months here. So those are kind of driving the higher level price increases, and they're up 2.65% year over year, while goods are up 1.67. But again, I think, as far as the FOMC meeting this week, the rate cuts have been pushed out. People have gone from expecting maybe a cut in the first half of the year and one in the back half to now I've seen September or December, but either way, they've gone from 2 to 1, and it's now at the very end of the year.
Yeah, it's pretty clear that after this reading, the Fed's focus is going to be shifting more towards the inflation side of the dual mandate. Like you said, at the beginning of the year, the markets were pricing in 2 cuts. It's now 0 to 1, and
Yep.
that probability of 0 is sort of quickly increasing.
Yeah.
So
definitely, we'll see what the coming data. They are data dependent. One of the hard things is all this data is obviously backward looking, and so it's kind of hard to forecast. But I think internally they're probably okay with a closer to 3% number. 2%, if you remember, was set back in between 2010 and 2020 when rates were 0. So I think they're internally probably okay with 3. But if they were to come out and say that, that would kind of shift things pretty markedly, especially over the longer term.
definitely.
On the income and spending side of things, consumer spending was up 0.38% month over month, beating forecasts, and ticked back up to 5.25% year over year. So those numbers, that's solid. That's good to see. You can see those green bars just chugging right along for the last, several readings. Incomes were up again, better than expected as well, 0.43%. Oh, sorry, not better than expected, just below, and slowed to 4.41%. There was the COLA, the cost of living adjustment, helped on the Social Security side of things. But basically, this is a solid reading on the incomes and the spending as well. So that kind of allayed some of the headline core PCE concerns. We also got CPI. CPI was up 0.27% month over month. And again, this is a month ahead of PCE. PCE is January. This is headline CPI for February. But core was up 0.22, both kind of in line with expectations. On a year-over-year basis, headlines at 243, while core slowed to 247. That's the lowest since March of 2021. So again, you see the difference in the breakdown in these baskets where core CPI is slowing to 247, while core PCE is up to 3.06. So there's different methodology inside of these. But again, the Fed kind of looks at the aggregate of them, I guess.
Right.
But they have come out and said that core PCE is their kind of preferred one. But these, relatively benign readings were kind of immediately overshadowed and written off by the fact that, oil jumped to $120 on like Sunday night and then dropped back down to 90 on Monday and is now back up above 100. So that's going to feed through into this headline CPI. Core won't be in there because that's X energy. But, the concern is this is going to feed through in the coming months, especially if the conflict in Iran continues to draw out longer than people thought. And again, we mentioned, there's that kind of hawkish path. That's more hawkish, fewer cuts on the FOMC expectations. And we'll get a little bit better view when they meet this week, because I guarantee they're talking about it. And hopefully the minutes when they come out, we'll have, or Powell's press conference will have a little bit of forecasting on what we see there, on what they see there.
Right.
Looking through at the basket within CPI, shelter continues to decelerate on a month-over-month basis, up 0.23, kind of slowing from January's jump. But the that number on a year-over-year basis is now at 296. That's the first time back below 3, the slowest since August of 2021. That's a big component in CPI. So to see that continue to decelerate is good. On the right, services continue to be more inflationary than goods. We're not showing goods here, but services are up 0.26 and slowed to 3.10% year over year. That is the smallest since August of 2021 as well. But again, we're still unwinding 4 years later after these like COVID distortions, which is kind of wild. But you can see there, shelter on the left, and I was finally back to kind of pre-COVID levels. Services on the right, getting back there. And then, goods, as we mentioned, not pictured, but up at scant 1.3. So those are almost, helping bring the overall CPI down. Quick update on oil. On the left here, you can see basically ship traffic through the Strait of Hormuz, courtesy of Goldman Sachs, standstill, just from, what is that, 50, 60, 70 to 0. And then oil prices on the right up to around 100. That's, a little dated now over the weekend. But again, those things are up at 105 or so. But that's likely to feed into inflation going forward.
Yeah, and something really quickly on those oil prices. One of the key variables that we're watching, in addition to the spot price, is the shape of the futures curve, and what some of those longer end futures look like as far as market expectations for the duration of the war. So last Monday, when you saw sort of the crazy intraday price action there, spot went up to 120, back down now below 100. December futures, sort of looking further out, back last Monday spiked up to $76 a barrel, and now we're actually back at around 75 again. So even though that spot price has come in a bit, your longer term expectations are sort of continuing to move up. That's a pretty important variable to watch with regards to, more persistent inflation.
Yeah, and especially kind of it's also a commentary on the duration of the conflict. The longer the Hormuz remains, in play or closed, basically, the kind of more lasting the duration of those higher oil prices are likely to be. We got Q4 2025 US GDP second estimate. It was basically cut in half. Came in at 0.65%. And the second estimate from the prelim of 1.42. You remember heading into the preliminary, which was a month ago, people were calling for a 3%. So they've gone from 3 expected a month ago to 0.65. But again, that's basically entirely due to the government shutdown and the resulting reduction in government spending. Consumer spending was revised down to 197 from 235. Most of the numbers were revised a bit lower on this reading. But again, government spending is really the big drag on here. You can see on the left there, that's the Q over Q figure for government spending. It was down 5.83, so even worse than the 5.12 in the prelim. It's the biggest Q over Q decline since Q3 of 2020, which was when we were unwinding all of the COVID stimulus in Q1 and Q2. And then on the right, we show the components contribution to GDP, and that government spending alone is a full 1% drag on the headline figure. As a percent of GDP, this is just kind of puts in perspective. Government spending is like 16.4% of GDP. It's the lowest share ever. So even at its lowest share ever, it's still like this is the biggest drag since Q3 of 2020 as well. PCE, personal consumption expenditures, were the biggest positive contributor at 1.33. That's just basically economic speak for consumer spending, which is like 70% of the economy.
Yep.
On the jolts, as we mentioned, there's just a lot of different data points out. So we'll shift gears to the next couple of slides here. Just each one is kind of a talking point. But for jolts, that is the Job Openings and Labor Turnover Survey. This is a little bit better than expected. The openings moved back up to 695, above forecast for 6.7. That's almost 400K month over month. That's the biggest since October of 24. Hires on the left inched up to 5.29. They kind of seem to be maybe kind of finding a bottom here as they were unwinding. Quits on the right, which is that blue, ticked back down to 3.14, while layoffs fell to 1.63. That's the lowest since March of 25. Layoffs alone are down by 260K in the last 3 months. Again, that non-farm payrolls number was pretty bad, but I think this is a month delayed, so we'll see if it follows suit. But this is just kind of a different way to look at the turnover in the labor market relative to just like the non-farm payroll figures.
Yeah, and this is a pretty encouraging reading. We had been seeing sort of weakness in the labor market around the margins. So this feels like a somewhat market reversal from what we hadn't seen in the past couple months.
Especially on that layoff side. And we've looked at, we made some talk about the challenger job cut announcements that have been running well above hiring. So to see those layoffs kind of fall back down. And again, the announcements are just that. They're only announcements. They don't track what actually happens. So it's not necessarily reality, but this is a little bit more reality based because these are actually layoffs that have occurred. So we're encouraging to see that moving back lower. We got durable goods orders. The headline, we're down 0.04% month over month, basically flat, but well below forecast for a 1.2% rise. On a year-over-year basis, they're still up 10.3%. Core capital goods on the right there, those are a closely watched business proxy spending. These are down, business spending proxy, I can say that. We're down a similar 0.03%. That's not great. It's the first down reading in 7 months, though, so it's like maybe we're due for one. I don't know. But again, these also get revised, so next month can be revised up or down relative to this. But year over year slowed to 4.34. However, it's down from 6.3 last month, which was the biggest since October of 2022. You can see both of these have been a kind of choppily accelerating uptrends on the year over year basis. And we kind of want that to be the case. You don't say, oh, we got one bad reading. Again, we need to see a trend here. And so seeing that on the core, kind of the core capital goods side, it's been good to see that going up and to the right basically since mid-2023. The trade balance, this unexpectedly narrowed to $54.5 billion. It's a deficit in January compared to forecast for 66.6, which is a little ominous when you just look at it. But exports jumped 5.5% month over month to over 300 billion. That's a record high and the biggest month over month rise since October of 21. Imports ticked down 0.7% month over month. On the right, you can see the kind of goods exports by end use category. And the other goods was basically the big. It's the little red line at the bottom. It's basically the smallest component on a dollar basis, but it was up 37% month over month, led by non-monetary gold and other precious metals. Then industrial supplies and capital goods ex autos also jumped to significant dollar month over month and dollar increases, and that's a big reversal after kind of 2025's volatility. And this is also good because in Q1, when you look at the trade balance and the effects that it had in 2025, this is a bit stronger than expected start for Q1 GDP tracking. So starting off on a good foot from that trade side of things for Q1 26 GDP as well. On the housing market, we got existing home sales. They ticked up 1.7% month over month to 4.09 million units, better than forecast for 3.89 million. They're still negative on a year-over-year basis at minus 1.4. Again, high prices, high mortgage rates, still stuck above 6%. Those are big buyers. It's also interesting that there are 6 million more jobs than there were in 2019, and yet home sales per year are down by 1 million, at least per the National Association of Realtors. So you're seeing a disconnect there, and that's clearly the effects of the high prices and the high mortgage rates. Housing starts improved overall, but we also got building permits. So the starts are not pictured. Permits are pictured because those have historically been a little bit stronger indicator of demand rather than starts. But permits fell to 1.376 million, missing forecasts, and they're down 5.8%. So again, the housing market's just kind of stuck in the doldrums for the time being. It's been a while. You're waiting to get maybe some breaks on the prices and the mortgage rates, but for the time, it doesn't seem like there's a whole lot moving here. We got the NFIB Small Business Optimism Index that ticked back down to 98.8 in February, below forecast for a 99.7 reading, down second month in a row. On the right, we show the sales environment, and it's been good to see the net percent of firms reporting higher sales versus the prior 3 years is now positive. It's +1 of firms reporting higher versus lower sales. That's the first positive reading since May of 2022, which is kind of significant. That number has been traditionally negative for what it's worth. So it's good to see that starting to kind of, or continuing to grind higher and get back into positive territory. But the outlook softened a bit as, it's now up to +8% firms seeing higher versus lower sales. But again, above zero is good. You want firms expecting higher sales relative to lower sales. But I think part of that in the report was that big businesses putting stress on smaller ones per the release.
Yeah, and one sort of subcategory not pictured here that was a little bit of a weak spot. 11% of smaller firms are now reporting poor sales as their most pressing issue.
Yeah.
Which historically has not been a great sign for the labor market. Again, sort of mixed readings there in terms of we had, a good labor market report with jolts and then some concerning elements here. But that's just one subcomponent that we're watching.
Yeah. So that's kind of it. I mean, that was a lot. Yeah, to take the bottom line on top. Core PCE was a big one, accelerating to 306. It's the highest since March of 2024. FOMC's out this week. We'll see how they kind of respond to that. Headline and core CPI up in line with forecasts, but they're still above 2% at 2.5% each. Again, concerns on the war in the Middle East continuing to push oil prices higher for longer is worrisome on the inflation side. Q4 2025 U.S. GDP second estimate chopped in half to 0.65 as government spending remains a drag, but that's going to unwind in Q1. And we've also got the trade balance, which is a positive start to that GDP forecast and that equation. Jolt surprised the upsides. Durable goods orders a little bit weaker than expected. Trade balance, again, more positive than negative for the GDP. Existing home sales better than forecasted, but permits decline. So again, you're getting some good, some bad at that mired housing market. And then an NFIB optimism, ticked down in February, but again, it's kind of on line with the long-term median. And given all the geopolitical uncertainty, I think we'll probably say we'll take it
Right.
as far as that. This week we get industrial production, manufacturing output. FOMC's probably the biggest piece. You get headline and core PPI and factory orders on Wednesday, and new home sales and wholesale inventories on Thursday. That's kind of all we got for the week. That was a lot. Have any questions, you know where to reach us. Thank you again, and we'll talk to you soon.